In today's video, we are going to analyze one of the most promising and one of Warren Buffett's favorite healthcare stocks out there on the market, which in my opinion is sadly less known than most of its direct competitors, and that is Merck Co. In addition to that, we are also going to evaluate how good of a buy they actually are and whether the company actually provides the enormous upside for the future that it seems to promise. This is Might As Well Invest, becoming smart money. Merck Co., which was founded in 1891, is a leading US-based healthcare company that is mostly known for its pharmaceutical products. And although Merck, in my opinion, can be considered less popular among investors, they are still quite a valuable company, with their current market cap of $193.3 billion. However, this valuation obviously does not come out of thin air and can to some extent be attributed to Merck's revenue in their last fiscal year, which in the year of 2020 sat at about $47.9 billion. To however get an understanding of what may drive Merck going forward, let's break that revenue down a little bit further. First of all, Merck divides their revenue into two segments. The biggest one of these being the pharmaceutical segment, which pulls in about $43 billion in revenue. This obviously has its subcategories of different drugs, of which Keytruda with its revenue of $14.3 billion is the biggest one. To just give you an idea of the sheer scale of this drug, this is an almost 30% year-over-year increase. But let's get back to the overall revenue and the second and smaller segment of theirs. And that is their animal health products and services, which contribute the missing $4.9 billion. But enough with the brief introduction. Let's get to the interesting part for all of those who already are shareholders or want to become such. And that are obviously the distributions to shareholders. Merck currently returns capital to their shareholders through a dividend and to some extent stock buybacks. However, let's at first take a look at the dividend, which currently sits at about $2.60, equaling a current yield of 3.38%. Pair this with a dividend growth of 11 years and a fairly decent 5-year growth rate of 6.72, which however has been growing rather rapidly in the recent years, and you get what can be considered a company with an already huge and growing distributions income. When it comes to stock buybacks, these are a little bit harder to track. However, it can be said that they sat at a rather low $1.2 billion in the most recent year. But let's take a look at the actual numbers in order to see how sustainable these distributions are and whether we might be even able to observe a higher distributions growth in the future. First of all, we are able to observe a free cash flow trend that is pretty much all over the board. Although this can by a large extent be attributed to acquisitions done by Merck, you should still note that this isn't the perfect trend for the long run. If we now put this into contrast with the distributions, these look rather unsustainable, as they exceed the free cash flow in almost every year. This in itself is a trend which we don't really like to see, as it means Merck will have to take on debt for the distributions at some point. However, let's take a look at their balance sheet, so we can get a more detailed overview of their financial position. As per usual, let's start out with the year of 2016, in which Merck's total assets sat at about $95.3 billion. These were made up by about $40.3 billion in equity, $24.8 billion in financial debt, and $30.2 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is obviously done using Merck's debt and its cash position of about $14.3 billion, with which we get a net debt of about $10.5 billion. If we now compare this to the year of 2020, we can see a small decrease in total assets to about $91.5 billion. These were made up by about $25.4 billion in equity, $31.7 billion in financial debt, and $34.4 billion in non-interest paying capital. Let's however again calculate the net debt just like we did for the year of 2016. This time however with a cash position of about $8 billion. From which we get a net debt of $23.7 billion, which is already a somewhat decent increase to the previous year. But let's also find out how sustainable the debt of Merck actually is and whether the debt has gotten more or less sustainable. This is done using the EBITDA, which after some basic calculations leaves us with a sustainability factor of 0.96 for the year of 2016 and 1.95 for the year of 2020. This indicates to us that the debt situation over at Merck actually got worse. However, it has to be said that this is still in a very sustainable position. Alright, so since we now have the financials covered, what we want to do is get the margin of safety, as this will help us with getting the fair price per share for Merck. First of all, I want to highlight one of the biggest factors that you should note when investing in healthcare companies, and that are patents. Patents can make or break a company's profitability, cash flow, and just overall moat against its direct competitors. Thereby meaning that if a company has a lot of drugs under patent for a longer time horizon, you as the investor can most likely count on reliable numbers. And I have to gladly say that Merck meets this criteria, as they not only have great drugs under patent, but they also have an amazing pipeline with about 20 therapeutics in stage 3 trial. Therefore, I will be reducing my margin of safety by about 5%. Although a huge pipeline is nice, I have to say that Merck's biggest upside lies in a drug that is already out there on the market. The drug which I'm talking about is the previously teased Keytruda. Keytruda is a drug which can be used in the treatment of almost every type of cancer and has been gaining rapid approval by different legislative government bodies, leading Keytruda to take the immune therapy market by storm with a revenue growth of 30% year over year, while the revenue of most competitors stayed pretty much flat in that time. To save you the explanation of why Keytruda stands out when compared to its competitors, I would refer you to the articles of medical professionals though. What is safe to say is that this drug is still under global patent until 2026, which reduces the risk of lookalike drugs taking market share from Keytruda. Plus, the most significant fact why I think the success of this drug will continue, cancer rates are growing, especially since life expectancy of humans is increasing. Therefore, I will be reducing my margin of safety by about 15%. When it comes to the downsides of Merck, I sincerely have to admit that I don't see any big and noteworthy downsides at the current point of time. To now get the fair value of Merck, we have to take a look at the historic dividend yield. For the past 10 years, this sat at an average of 3.28%, thereby meaning you want to buy the stock if the yield is above that. But to put it into numbers, with the current dividend of $2.60, a fair price to pay would be $79.26, which would mean with the current share price of $76.31, you would be getting a 3.73% discount. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 3.28% and add my safety margin of 5% to it. This gives us our target yield of 3.44%, which leaves us with a price to buy the company at of $75.58. To conclude, I have to say that Merck is an, in my opinion, amazing company. Sure, their free cash flow to distributions trend isn't the best one I've seen. However, I find Merck to be a good opportunity to actually do something good with your money. Sure, their quite big dividend is nice. However, supporting the cause behind things such as Keytruda and other therapeutics of theirs looking to fight huge illnesses are, in my opinion, amazing. From an investor standpoint, I however also have to say that with their huge pipeline and already existing products, Merck is looking like one of the most promising healthcare stocks for the coming years, for which reason I will also rate it an absolute buy.